Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Microport Scientific Corporation Annual Report. Microport Scientific Corporation offers a wide range of businesses and services across various medical device segments. The company's primary focus areas include cardiovascular devices, orthopedics devices, cardiac rhythm management, endovascular and peripheral vascular devices, neurovascular devices, surgical robot business, and surgical devices. The cardiovascular devices segment is the largest contributor to Microport's revenue, offering solutions for coronary artery-related diseases, including coronary stents, delivery systems, balloon catheters, accessories, and active devices. The orthopedics devices segment provides reconstructive joints, spine and trauma products, and professional implants and instruments. In addition to these segments, Microport also offers cardiac rhythm management solutions, including defibrillators, cardiac resynchronization therapy devices, and pacemakers. The endovascular and peripheral vascular devices segment provides disease solutions for interventional treatment of thoracic and abdominal aortic aneurysm, peripheral vascular diseases, aortic dissection aneurysms, and other arteriovenous-related diseases. The company's neurovascular devices segment offers neurovascular therapeutic and access devices for cerebrovascular diseases. Microport also has a surgical robot business segment that provides surgical robots with advanced features such as robot ontology, control algorithm, electrical engineering, image-based navigation, and precision imaging. Furthermore, the company's surgical devices segment offers various surgical devices to support its other business segments. Additionally, Microport is involved in the distribution of medical devices globally, catering to customers in China, Europe, Middle East and Africa, Japan, and internationally. Microport Scientific Corporation maintains a market capitalization of $17 billion, broadly in line with the industry peer group. Microport Scientific Corporation trades at a higher price-to-book ratio of 3.47 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 68% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have increased, while assets and equity have failed to keep pace or declined. This suggests the business is not growing and may be in decline, making it a highly unattractive investment from a risk perspective. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth for a company can be attributed to several key factors. Firstly, the commercialization of new products and technologies has been instrumental in driving revenue growth. The Glow Matrix commercialization platform, for instance, has seen a 78.8% year-on-year increase in revenue. Additionally, overseas sales of surgical robots and structural heart disease products have experienced significant growth, with increases of 286.6% and 255%, respectively. The company's expansion into new markets has also contributed to its revenue growth. Successful entry into multiple new markets for the structural heart disease business has been a major driver of growth. Furthermore, breakthroughs in evidence-based medicine, technological advancements, and normalization of value-based purchasing, VBP, policies in China have all played a role in driving revenue growth. In terms of specific products, the company's core product success has been notable, with Castor and Minus entering approximately 30 countries/regions. The approval and market access for new generation thrombectomy and aspiration products have also contributed to revenue growth. Additionally, the company's robust global commercialization efforts and strong R&D innovation have driven growth. On the other hand, several factors have contributed to revenue decline. Geopolitical conflicts and healthcare system fluctuations have led to a decrease in overseas revenue of 10.1%. The international market has experienced a year-on-year decrease of -1.6%, while the Chinese market has seen a decline of -45.4%. Additionally, the Europe and Asia markets have also experienced declines of -19.3% and -27.1%, respectively. The net income of the company has experienced significant growth, increasing by $60.5 million and a staggering 89.5% year-over-year. This upward trend is even more pronounced in overseas markets, where it rose by an impressive 142% compared to the previous year. The profit margins have also seen notable improvements, with the adjusted net profit margin remaining above 20% for 2 consecutive years. The gross margin has increased across various segments, including a 12.6% rise and a 1.7 percentage point increase year-over-year. Additionally, the Microport Neuroscientific business saw its gross margin expand by 0.5 percentage points to 73.5%. The overall profit margin also experienced a notable boost of 3.3 percentage points year-over-year. These improvements in net income and profit margins can be attributed to various factors, including strategic business decisions and market conditions. The company is indeed generating positive operating cash flow, as evident from the various financial statements and projections provided. On page 1, it is mentioned that the company has generated $69,132 in net cash from operating activities. This trend continues throughout the document, with a positive operating cash flow confirmed on page 3 for the year 2025. Furthermore, the operating cash flow for 2025 is reported to be a substantial $1,234,219, page 6. The company's ability to generate sufficient operating cash flows is also highlighted in its cash flow projections, which indicate that it will meet its liquidity requirements for at least 12 months, page 10. Additionally, the improvement in free cash flow position and narrowing of net loss by 60.7% year-on-year, page 45, demonstrate a significant positive shift in the company's financial performance. Overall, these indicators suggest that the company is generating sufficient operating cash flows to support its operations and meet its financial obligations. The company's debt level and interest expenses have undergone significant changes in recent years. On one hand, the total borrowings decreased by $47.8 million, indicating a reduction in debt levels. However, this decrease is offset by an increase of $96,321 in interest-bearing borrowings and a 2.9% increase in interest-bearing borrowings to $21,855,000. In terms of interest expenses, there has been a significant increase from $57,709 in 2023 to $58,205 in 2024. This increase is largely driven by the interest expenses on convertible bonds issued by the company, which have increased from -$33,416 in 2024 to -$42,930 in 2025. The total interest expense on financial liabilities not at fair value through profit or loss has also increased by $4,882. Overall, while there are mixed signals regarding the company's debt level, the increase in interest expenses suggests that the company is paying more for its borrowings. The performance of various segments and regions within the company has been mixed, with some areas excelling while others struggled. Segments such as orthopedics and endovascular have performed well, with notable achievements including a net profit of $77,700 for orthopedics and a significant revenue of $169,537 million for endovascular. The cardiovascular devices business also saw an 11.1% increase in revenue, excluding foreign exchange impact. On the other hand, segments like cardiac and peripheral devices business, neurovascular business, and cardiovascular rhythm management business have underperformed, resulting in net losses of $37,612, $148,405, and $62,540 respectively. The orthopedics devices segment also saw a 7.5% decrease in revenue, excluding foreign exchange impact. In terms of regions, the US and Japan have performed well, with the US generating significant revenue of $169,540 $537 million, and Japan experiencing a 7.2% increase in revenue. Overseas markets have also shown promise, with the company obtaining 407 initial registration certificates in 53 countries and regions. However, Region B has struggled, resulting in a loss, while the PRC saw a significant decline in revenue of 45.5%. Management is optimistic about the company's outlook, citing sufficient financial resources to continue as a going concern for at least 12 months. They attribute this confidence to the resilience of the Chinese economy and the solid demand foundation for the medical device industry, driven by population aging and improved health levels. The company has demonstrated operational resilience in a complex global environment, maintaining its strategic focus while implementing adjustments to enhance operational quality and sustainability. These efforts have paid off, with the group turning profitable due to significant improvements in EBITDA. Overall, management's message is one of stability and growth, highlighting the company's ability to navigate challenging external conditions and capitalize on emerging opportunities. The company's financial history reveals a commitment to returning value to its shareholders. One key aspect of this commitment is the payment of dividends. This indicates that the company has distributed a portion of its profits to its investors, providing them with a regular income stream. In addition to paying dividends, the company has also engaged in share buybacks. This strategy involves using the company's funds to purchase back its own shares from the market, thereby reducing the number of outstanding shares and potentially increasing earnings per share for remaining shareholders. There are growing concerns about inventory buildup and supply chain disruptions. The main reasons for these concerns include global supply chain fluctuations and geopolitical conflicts. These issues have been highlighted in various sections of a report, specifically on pages 38 and 52. The impact of these disruptions is particularly evident in the orthopedics devices segment, where supply chain challenges are posing significant risks to businesses. The uncertainty surrounding global supply chains has led to concerns about inventory buildup, which can result in stockouts, lost sales, and decreased customer satisfaction. That concludes the financial summary for Microport Scientific Corporation. Feel free to comment below, and I will be happy to answer them when possible.